Hey everybody, Chuck Barone. Tuesday, December the 6th, 2022, and on goes the crazy we've been following for you guys. Never ends, guys. Hopefully we're going to have a little ho-ho-hoing this month, and this market will take a break from some of the crazy, but let's get into the show. As always, we want to welcome you to the show. Thank you for your support. All you guys do every day, watching the videos and, sharing these videos with your friends, your questions, your likes, comments, all the stuff you guys do every day to help make the show a success. We really appreciate you guys. Markets today, not a great day for stocks, guys. Stocks down across the board. The market getting that sinking feeling. This is exactly the way I called it last week during that crazy market rally. I told you guys it was a mirage. It was the market always is bullish. The market always wants to go up. So the market got into Powell's remarks last week and kind of took from them what it wanted. And I was telling you guys then, hey, the first whiff of bad news or contrary to this new consensus of baloney, they're going to give it all back. And here they have now in just a matter of a couple of days. This stock market is not looking great right now, guys, depending on the sector. If you're in defensive position like we've been advocating, you're hanging in there. You're in some of the bigger growth stocks, the Googles, the Metas, and some of the others, well, your things aren't going as well there. The bond market today had a nice little rally, go figure, with the 10-year sitting at 3.51%, down 9 basis points today. This thing was just like, I want to say within the last 2 weeks, was just sitting at just under 4%. Now you tell me, guys, what has happened in this economy in the world that leads us to believe rates should be half a point less than they were 2 weeks ago? It's just bananas. The 2-year drops down today only by 4 basis points to 4.36 on the index. So now you're looking at, 85-point inversion. It keeps getting wider. They say that the wider the inversion, the worse the recession that follows will be. Typically, when you have an inverted yield curve, and when I say inverted yield curve, I mean the shorter term bonds have higher rates and yields than the longer term stuff. So the yield curve typically goes, basically diagonally from your left to your right, the yield going up as time goes out and you get risk added in over time. Nowadays, the yield curve is the exact opposite. Has a kind of a weird glitch in it though, but anyway, the 2-year way higher than the 10-year, and then you got to go up a little bit to the 30-year. But the bond yield, that inversion is always a warning of a recession to come. It's basically batting 1,000%. It never fails. Now we already thought we were in recession earlier this year when we had the 2 negative quarters. I don't really know for sure how that's going to play out. I was peeking today, and the GDP Now tracker for the Atlanta Federal Reserve Bank says fourth quarter GDP will grow 3.4%. Take these numbers with a grain of salt. But nonetheless, if that comes out that way, that'll be now 2 consecutive quarters of positive GDP growth. We'll have a positive GDP growth for the year in 2022. I don't know if you can actually call that a recession. I guess technical recession maybe. Anyway, so the bond market, crazy. Dollar today up very small, 105.55 on the dollar index. Still the champ, still unchallenged. The dollar, I guess, is right now, until the rest of the world catches up with us on rate increases, then the dollar's going to stay high. As the euro and some of these other world currencies catch up, as their rates increase, then the dollar will come back down to earth. With the dollar up today, metals down small, well, mixed actually. Silver actually, or gold actually, was up small today, up $2.80 at $1,772 and change per ounce. Silver down 6 cents, $22.18 per ounce. Metals holding their own, man. I mean, they are. I really think that metals are like the proverbial racehorse in the starting gate, just pawing at the ground, ready to take off, looking for the catalyst to do it. I think that it'll be this dollar. As the dollar comes back down even to 100, which is a pretty strong dollar number, metals are going to fly, guys. Oil today down again, down $2.54, $74.39 per barrel for a barrel of your West Texas Intermediate. Where is it? When are we going to see this at the gas prices, guys? Okay? When OPEC kind of stiffed President Biden and announced they were sticking to their guns as far as production, there would be no additional production. Oil spiked up close to $100 per barrel. Now, down to under $75 per barrel. But here, at least in Nevada, no corresponding decrease. 25% drop in the price of barrel of oil. I guess it doesn't correspond to a 25% drop in the price of gasoline, at least not here in Nevada. Natural gas today, continuing its wild ride, down 3.5%, $5.38 per million BTU. That market's just been going crazy. Volatility like I've never really seen before. As I've been saying, if you're in this market, if you're playing options, futures, whatever, be very, very cautious. Bitcoin today up very small, 34 bucks. Last time I looked was sitting at $17,000 even, plus 28 cents. Bitcoin hanging in there, guys. If you have any worries about Bitcoin and you own it, maybe this is a time to get a little bit of your money back if you can. I think that this market has got some serious issues. I think there's going to be some major scrutiny coming at them, but all these cryptocurrencies from the government. When you're staring an $8 billion disaster in the eye, the government's always going to come sniffing around, especially at the behest of their Wall Street masters, who, as we all know, are not big fans of cryptos. Anyway, Bitcoin holding on, 17,000. News you guys need to hear today? Well, there really wasn't much news today. That's coming tomorrow and Thursday. But today we got trade deficit numbers, and they were nothing to write home here about, guys. Bad trade deficit numbers. The deficit up 5.4% this month, 5.4% up to $78.2 billion. So we're spending almost $80 billion a month on more foreign goods than they're spending on our exported goods. This is not good. The sad thing is a lot of these imports are coming, basically, they are American companies importing from cheaper labor spots. I would like to know, of this deficit, $78 billion deficit, how much of that import came from U.S. companies? That would be interesting to know. U.S. exports really having some difficulty right now, falling to a 7-month low. The strong dollar really eating into that. Not to mention recession, weak demand, inflation all over the Eurozone and some of our other big trading partners. The strong dollar hurts our exports, guys. Makes the imports coming in a little bit cheaper. So if the dollar continues to stay as strong as it has been, expect the trade deficit to continue to grow. Extra stuff I thought you guys need to know today. The big one that I saw, and this one it's not a shock. It's just kind of a sign of the way things are going and going to continue to go. Blackstone. We talked about them last week, how they're limiting redemptions on their $70 billion real estate fund. Well, now it looks like their troubles are growing. They have a private credit fund, which is friggin' gigantic, and they just tapped out a $5 billion limit on their redemptions. So now every fund at Blackstone, they all have these limits put in, but now they're all starting to hit those limits. Money's starting to get withdrawn. I'm not surprised. Really, really bad news for Blackstone because, as I said when we were talking about this last week, once people have a feeling or a fear that they might not be able to get their own money out of an investment, that stirs up some panic. And now everybody starts heading for the exits at the same time. I got a funny feeling that Blackstone's going to get flooded with redemption requests now. The real estate fund has already been limiting redemptions. They only filled 43% of the redemption requests in November. I got a funny feeling December is going to be a worse month. Now you got this contagion bleeding into their other funds, which is a really big problem for them. So now Blackstone in the market selling assets, as we mentioned last week, selling out their ownership interest in the MGM Casino, the MGM Grand, and the Mandalay Bay. They owned all the buildings and the properties on that, sold out their share of that to Vici. Raising cash. I think what's happening is now they're really going to have a big problem, though, as I was saying. When investors panic, that's not something that stays quiet, right? So now as they start to panic, they panic other investors, and this thing really starts going crazy. I think that it's bad news not only bad news for Blackstone, but bad news for real estate, because a lot of the real estate people and builders and people in the industry, which is basically shut out real buyers right now with rates being where they are, was hoping that Blackstone and groups like them would fill the slack with their buy-to-rent programs where they buy up basically whole neighborhoods and just turn them into rental properties. Well, it doesn't look like. If these redemption issues are any kind of an indication, Blackstone's days as a giant player in real estate might be numbered here, guys. And even worse, now this is starting to spread to other funds, as Starwood, another very big real estate investment trust company, has had to limit redemptions on their biggest real estate fund. Now this fund is significantly smaller than Blackstone's $70 billion, but it's still a $14.6 billion fund. Starwood has $125 billion under management, almost all of it in real estate. They had to limit their redemptions last month to 63%, which is much better than Blackstone's 43%, but it's just starting the ball rolling on these redemptions out of the real estate investment trusts. Everybody knows real estate's going to go down. Investors want their cash out. These big trusts having big difficulty. When you're getting redemption requests maxing out, and it's starting to become a monthly thing, well, you guys, you don't have to be Nostradamus to read the writing on the wall for that stuff, right? So the beat goes on, guys. Crazy world we're living in. This recession that's coming is going to be a pretty rough one, I think. Depending on where we go with these rates and how things hold up in this country, I think a lot of businesses right now are doing well. Service businesses, especially per our report yesterday, restaurants that I'm seeing, restaurants and bars are full. They're sure not having any problem packing them in the Strip. The Strip's another month last month, $1 billion in earnings, record-breaking numbers of people flying into Vegas. So this recession's an odd one if we're in one. Anyway, we're going to carry. Tomorrow's a big day, guys. Lots of data coming tomorrow. I'm sure it's going to be an interesting day in the markets. I think that the data we're going to get in the next 2 days will be really good for us to get an indication of where we're going as far as what the Fed's thinking is going to be. I'm going to kind of try to translate that out for you. Now, I'm no mind reader, but I can tell you what would normally happen in normal circumstances. I don't know if we have normal bankers anymore, or these are normal circumstances, but we'll try to do our best to translate it to give you guys the best idea of where you should be heading right now as far as investing goes. In the meantime, guys, keep following the advice we've been giving you guys. Play it cool right now. You'll be glad you did later. Anyway, that's it for today. We really appreciate you guys, the support you give us every single day. We'll be back tomorrow with a big data day tomorrow. Hopefully the market will be a little bit more positive tomorrow. In the meantime, guys, until we talk then, take care. Thanks.